Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 5th of June 2020. I am still expecting upward movement again next week. The next target is at 3238. I've been expecting upward movement since March. The first target was met and price kept going higher, and so attention is now turned to the second higher target. Since March, I've been expecting that this upward movement is a counter-trend movement, a dead cat bounce, or a bear market rally within an ongoing bear market. However, at the end of this week, we now have some technical indication that that may not be correct. The AD line has made a new all-time high, and so now I will publish a bullish wave count, and I'll do it at the monthly chart level. My main wave count will still expect that an ongoing bear market may continue when this bounce is over. For the short term, both ideas will expect the same movement, and we'll get to that difference when we get to weekly charts. For the short term, I am still expecting more upward movement to the target at 3238, and then I am expecting to see a downward movement. In order to indicate that the upward movement is over, I will still be looking at the same things. I will still be looking for a bearish candlestick reversal pattern and a breach of the upward sloping trend channel by downward movement. I'm going to do this differently. We're going to look at monthly charts in a tiled format. I'm going to show you all of the monthly charts 1, 2, 3, 4 all together side by side. I want to look at the differences so that we can understand and have a clear understanding of what the differences are. This is wave 1, or the first main wave count, the first alternate, second alternate, third alternate. So I've got 1, 2, 3, 4 wave counts ranked in this order of probability, roughly in order of probability, with this wave count possibly the highest probability at this stage. 1, 2, 3, or the main count, first alternate and second alternate, all see the subdivisions of the bull market in the same way, except for the degree of labelling. The bull market from March 2009 to February 2020 is seen as a 5-step forward pattern, a 5-wave impulse. This is the simplest Elliott wave structure. For the main wave count, it is labelled primary 1, 2, 3, 4, 5 to complete cycle wave 1. If cycle wave 1 is over there, then probably a zigzag for cycle wave 2 may have begun and may be incomplete, and the target remains the same. When 2 is complete, then 3 higher should begin. When 3, 4 and 5 are complete, then super cycle 5 may be complete. But if we move the degree of labelling of this bull market all up 1 degree, then we get the first alternate monthly chart. Now I've just moved that degree of labelling up 1 degree. So instead of primary 1, 2, 3, 4, 5, now we've got cycle 1, 2, 3, 4, 5. If that's the case, then there could have been the end of super cycle 5, which means grand super cycle 1 may have ended in February 2020 and an absolutely huge devastating bear market could have begun. We are considering all possibilities in this video today. If that's the case, it should begin with a pretty obvious 5-wave structure down at the monthly chart level. A grand super cycle wave should last at least 10 years, possibly a generation. Bear markets for this particular market do tend to be more brief than bull markets. This grand super cycle first wave has lasted generations, plural. For this wave count, this invalidation point is absolute. A new high, even by a fraction of a point on a tick chart, is enough to invalidate it. If we go back to my first wave count, we're seeing cycle wave 1 over here. My first main wave count sees cycle wave 2 incomplete. But what if we move the degree of labelling just within this little piece of movement up 1 degree? Well, then we get this third wave count. This is the same, and now I'm simply considering the possibility that cycle wave 2 was over as a relatively brief, very brief and relatively shallow zigzag. That is possible It will subdivide as a zigzag at lower time frames, and so let's consider all possibilities. This is a fairly bullish wave count. If a second wave is over there, then a third wave is just in its early stages. It may only subdivide as an impulse. This third alternate and my last monthly chart is new, and this is really different, and this is also bullish, but not necessarily as bullish as the second alternate. From this low to this high, I am seeing the subdivisions quite differently. Instead of 1, 2, 3, 4, 5, I'm seeing it as 1, 2, 3, 4, 5. 2 is a zigzag, 4 is a complete expanded flat. A fifth wave may be beginning here. This may make a little bit more sense than considering a third wave beginning here, and for that reason I do want to consider this alternate wave count. The channel is different because it doesn't really work if you use Elliott's technique, but if you draw it like this, from the start of the bull market to the end of cycle 4, and then you pull a parallel copy up to contain all of it and you add a midline, it actually has a pretty good fit. There's a nice Fibonacci ratio between 3 and 1, all the subdivisions work pretty good, and 5 could have begun here. If 5 is only equal in length with 1, or 1.618 the length of 1, this is a semi-log scale, then it would not make new all-time highs. So I've used the next Fibonacci ratio in the sequence, 2.618. And so the first wave count sees a bear market continuing for a zigzag for a second wave, which may not move beyond the start of the first wave. The first alternate wave count sees the bull market over and a huge devastating bear market in its very, very early days. The third wave count sees the bear market over as relatively brief and shallow, and a third wave beginning upward. This is the most bullish wave count. And the last, the third alternate monthly chart, sees the bull market incomplete and a fifth wave in its early stages. Okay, now I'm going to go through each of those wave counts, and I'm going to look at lower time frames as well. This is the first main wave count. The bull market is seen over here. It's a 5-wave impulse and followed by a 3-step back pattern, the simplest Elliott wave structure. 5 steps forward, 3 steps back. 3 steps back may not move beyond the start of 5 steps forward. This 5-step forward pattern has an extended first wave, double combination for the second wave, impulse for the third wave, double zigzag for the fourth wave. There's alternation between 2 and 4, combination, multiple zigzag, and a fifth wave. When we see this labeling in this way, the third wave corresponds to the strongest portion of MACD. The third wave of the third wave corresponds to the strongest histogram within MACD, with the exception of the beginning of the whole movement. The first wave was particularly strong. That's quite common for the S&P. There is no Fibonacci ratio between the third wave and the first wave, and the fifth wave is shorter than the third. The third wave is shorter than the first, the fifth wave is shorter than the third, and the first wave is the long extension. When we draw an Elliott channel around this impulse, when it's labelled in this way, we draw from 1 to 3, we placed a parallel copy on 2. This is particularly compelling for this wave count because this channel actually has such a textbook perfect fit. It then perfectly shows where this fourth wave found support, and the strongest portion of the bull market, the middle of the third wave, has an overthrow. There's the tiniest overthrow also at the end of the fifth wave. Because this channel has such a good fit, it is a compelling indication that this may be the correct way to label the bull market, but it is not the only way, and I will consider other possibilities. If 5 steps forward is over here, then we're entering 3 steps back, and the question now becomes, is it over there, or is it going to continue, and what structure is it going to be? If it's a second wave, it's most likely to be a zigzag. It's most likely to not be over there. That would be really brief and shallow, so the most likely scenario would be it's going to continue lower. The target is for cycle 2 to reach 0.618, the length of cycle wave 1, and I don't draw my Fibonacci retracements on these charts because motive wave gives it a logarithmic calculation, and I want my Fibonacci calculations to be arithmetic, so I'm just giving it to you with this target notation here. Cycle wave 2 may not move beyond the start of cycle 1 below the start of the bull market. Let's take a look now at the weekly chart level, where the high for cycle 1 is this point up here. If cycle 2 is subdividing as a zigzag, we will label it primary A, primary B, primary C, and it will subdivide 5, 3, 5, and B may not move beyond the start of A. This wave count expects that this upward movement is a dead cat bounce or a bear market rally, that the bear market is ongoing, and when this bounce is complete, the bear market would then resume with quite a lot of strength. C waves can behave like third waves. They can be particularly swift and strong. If A subdivides as a 5, then B may not move beyond its start to make a new all-time high. The target for now is cycle 2 to reach 0.618, the length of cycle 1, but for this wave count, when and if we know where B may have ended, then I know where C may have begun, and I can add to the target calculation at a second degree, a primary degree. At that stage, it may widen to a small zone, it may change, or I may have multiple targets for you. Let's take a look now at the daily chart level, where the low for primary A is this point down here. Now we're looking in more detail at this possible zigzag for cycle 2, 5, 3, 5. Primary B may be subdividing as the simplest Elliott wave structure, a zigzag A, B, C, the simplest corrective structure, subdividing 5, 3, 5. The target is for intermediate C to reach 0.618, the length of intermediate A. This channel is going to be really important in the next couple of weeks. This upward movement for all of our wave counts will at some stage end, and we will be seeing a downward movement to follow it. How deep that downward movement goes will be different for different wave counts. The channel will be used in the same way. Draw it from the start of the movement to the end of this low, and use this lower edge of the channel as a guide for support for deeper pullbacks. If this trend line is breached by downward movement, particularly if that comes after a bearish candlestick reversal pattern, then I will expect that this upward movement is over and the next wave down may then have begun. At the hourly chart level, I'm looking now at the end of intermediate C. We have 3, 4, and an extended fifth wave. I'm still going to label it like this because it still mostly fits with MACD. From here on upward, it looks like an impulse, maybe nearing completion. 1, 2, 3, 4, 5. Draw a channel around this from 1 to 3 with a copy not on 2, but pull it lower to contain all of this movement, so it's not quite an Elliott channel, it's adjusted, and now it contains all of this possible fifth wave. Look for the fourth wave if it's deep and time consuming to find support about the lower edge. If this labelling for the short-term picture is correct, then 4 may not move into 1 below the invalidation point. If this invalidation point is breached, that would also be a breach of the big upward sloping trend channel, and if that happens, I'll be labelling primary wave B over here, and I'll start to calculate targets for you for primary C. For now, the target remains the same at 3238, and we're getting fairly close. At the weekly chart level, this is an alternate wave count. This is exactly the same as my first weekly chart, and I'm still seeing cycle 1 over here and cycle 2 underway, but now I'm considering a different structural possibility for cycle 2. My first weekly chart, my first daily chart, considered a zigzag, 5, 3, 5. A zigzag has B, can't move beyond the start of A. But cycle 2 doesn't have to be a zigzag. It can be any Elliott wave corrective structure except a triangle. The next most common Elliott wave corrective structure is a flat correction. The zigzags are the most common corrective structure by quite a wide margin, but flat corrections are also quite common. So let's consider both of those possibilities. Flat corrections subdivide 3, 3, 5, and the B wave within a flat correction may move beyond the start of the A wave, as in an expanded flat correction. The minimum requirement for a B wave within a flat is to retrace 90% the length of the A wave. In this instance, it's at this price point. The common range for a B wave within a flat is from 1 to 1.38 times the length of the A wave, giving us this range, allowing new all-time highs, and yet the bear market could then continue with a devastating C wave to move beyond the end of the A wave. And so we do need to consider this possibility as well. The difference would be in technical analysis. B waves should exhibit weakness. This B wave should exhibit bearish divergence with price and RSI at highs. It should exhibit divergence with price in the AD line. We don't have that yet. We'll get to that last at the end of the video. It should also exhibit declining range and declining volume. B waves should be reasonably unmistakable. They really should exhibit weakness. At the monthly chart level, this is the first alternate wave count, which I went over at the beginning of the video, and now I'm going to have a little bit more detailed look at these monthly charts. From the low here to the high here, the start of the bull market to February 2020, I'm still seeing this as the simplest 5-step forward pattern. 1, 2, 3, 4, 5 at cycle degree here. I've moved it all up 1 degree. If that's correct, then super cycle 5 could be over and grand super cycle 1 could be over, which means we could have had a huge once in generations trend change and an absolutely devastating bear market in the early stages. The difference between the first monthly chart and this first alternate monthly chart is this price point here, and we're not going to know which of those two scenarios is correct until this price point is breached, which is a long way away, possibly years away. And so we may have to run those two wave counts side by side if the bear market does continue. For this wave count, if we've had a once in generations trend change, it needs to begin a 5-wave structure downward at the monthly chart level, and within that, no second wave correction may make a new all-time high. A new high by a fraction of a cent on a tick chart is enough to permanently invalidate this wave count. There is no other iteration of this I can see at this time. We would still approach, of course, the trend change in future, but for now, if we see this wave count invalidated, it's invalidated. At the daily chart level, here it is, the end of grand super cycle 1 and the start of grand super cycle 2, with cycle 1, cycle 2 may not move beyond the start of 1. The invalidation point, the target, the channel, everything is the same. It's just all 1 degree higher. At the hourly chart level, it's all the same. It's just 1 degree higher. So I'm going to use the channel, the invalidation point, all of it in exactly the same way. At the monthly chart level, from this low to this high is absolutely identical to my first monthly chart. The degree of labeling is the same as my first monthly chart. I'm now seeing only cycle wave 1 within super cycle 5 over in February 2020. Now the degree of labeling here is different. If we move the degree of labeling up for this downward movement, what if the pullback was over? What if we have 5 steps forward and a really brief shallow 3 steps back? This is an alternate because this has a low probability, because this little movement here looks to be far too brief and too shallow to be a normal looking second wave correction. A cycle degree second wave over in just over a month, not even a full 2 months, that really does look too brief. But let's consider all possibilities. If this is the case, then a third wave up may have begun here. If this has a lower probability, what that means is the probability that prices in the early stages of a third wave would be quite low. I've calculated a target for you. I've got an invalidation point for you. This invalidation point for this second alternate wave count is absolute. Within a third wave, the upcoming movement for primary 2 may not move beyond the start of primary 1. I would still be seeing this upward movement nearing an end soon, because we are starting to see a little weakness, and I'd be expecting a pullback and the second wave correction would be expected to possibly be quite deep and definitely reasonably time consuming, and it may not move beyond the start of one. And so if this wave count does turn out to be correct, and we would have indication it may be, if we see new all-time highs, then we'll start to take it more seriously, we would still have an opportunity for entry on a pullback that would still be coming up. And finally, a different way of labeling this bull market. This wave count is new. I took a blank chart, and with Caesar's help we came up with a really different way of labeling this movement, which took a little while, but this has a really good fit and a pretty good look. But when you try and draw an Elliott channel around it labelled like this, it just doesn't work at all. But this channel does have a pretty good look. What if we see 1, 2, 3, 4, 5? Now we've got the expanded flat that members have been asking about, and I have to say this does look pretty good as an expanded flat. An expanded flat for cycle 4 gives nice alternation with a zigzag for cycle 2. But if we draw channel using Elliott's technique from 1 to 3 with a copy on 2, it just doesn't fit. If we draw it from 2 to 4 with a copy on 3, it doesn't have a very good look either. But if we draw a channel from the start of the bull market to this low here and push a parallel copy up and then add a midline, most of the bull market fits in the upper half of the channel, and now price is back in the upper half of the channel again. This has a pretty good look. This wave count expects not a third wave as the last one, but a fifth wave, and that may actually make a little bit more sense. The target here I don't have a lot of confidence in though, because for this wave count, cycle wave 3 exhibits a fairly decent Fibonacci ratio to cycle wave 1. The length of cycle 3 here is 39.38 points less than 2.618 times the length of cycle wave 1. And so when the S&P exhibits a ratio between 1 and 3, it makes it less likely that we're going to see a ratio between 5 and either 1 or 3, because it's fairly common for the S&P to exhibit a Fibonacci ratio between 2 of its 3 actionary waves, and actually rather uncommon for the S&P to exhibit a Fibonacci ratio between all 3 actionary waves. The target for the final end to this wave count would best be calculated at primary degree, but I can't do that until primary waves 1, 2, 3 and 4 are all complete, and then I know where primary 5 may start, and I can use ratios between 5 and either 3 or 1 to calculate the final target. Pretty obviously I can't do that yet. I can only calculate it at cycle degree, and so I have, but this target is provisional. It would probably change if this wave count turns out to be correct. This wave count allows for new all-time highs, but the fifth wave would be expected to exhibit some weakness. It could last a year or longer. It could last up to 7 years possibly. It's unlikely to be as extended as the first wave. It's possibly more likely to have some kind of ratio or look to the first wave. This wave count has a long extended third wave, so I'd expect the fifth wave to be shorter than that. Within it, primary 2 may not move beyond the start of 1. This invalidation point for this wave count is absolute. A new low by a fraction of a point on the tick chart would be enough to invalidate it. Okay, let's do a thorough technical analysis of this market. We have the month of May complete. This is the month of June. We've only got a week of June, so we can't analyse that candlestick, but let's take a look at this one. For May, we saw some decline in volume. Volume is not supporting upward movement. We've also seen a decline in range. Range is not supporting this upward movement. However, that's not entirely unusual for the start of a sustained bullish trend for this market. Here we see a decline in range, but we didn't see such a decline in volume. So the decline in volume is a little bit more concerning. However, I would like to note on this chart that this bull market, and this is almost all of it, has proceeded with light and declining volume, not just for months but for years. That it has been a highly unusual feature of this bull market, which all the textbooks tell us cannot be sustained, yet in this case it obviously has been sustained for over a decade. And so it could pretty obviously be sustained again. I think what that means is eventually this bull market will end and we will get a bear market. It's being rather difficult to figure out when it's going to arrive, but when it does arrive, there is weak or thin support below, and so the lack of volume here means that eventually when price does turn and fall, it could fall particularly hard and violently. We may not be there yet, we may be on the verge of it. I have wave counts for both scenarios. There was quite strong bearish divergence at these highs, and there was a really strong bearish engulfing candlestick pattern followed by a shooting star. Two strong bearish candlestick patterns following strong bearish divergence did quite strongly suggest a bear market may possibly begin here. That would tend to offer a little bit more support to one of those first 2 monthly charts, the main or the first alternate, possibly. RSI is in neutral territory. There is plenty of room for price to rise or fall. On balance volume broke below weak support. There's no new range here. ADX is indicating a downward trend. ATR is rising during a correction. That's normal behaviour for this market. At the weekly chart level, though, the shorter term picture looks more bullish. We've had a really strong upward week. Support, which was quite strong at 3020 to 3025, was overcome. Some energy was released and prices jumped up to the next area of resistance. Resistance was overcome. It now turns to support. Next area of resistance, not so strong, is at the round number pivot of 3,200. A strong upward week with some reasonable support from volume suggests more upward movement next week. Overall, though, volume is overall declining. That could change, but with the data we have in hand at the moment, overall there is some decline in volume. On balance volume bounced up off support, has broken above resistance. It's giving us a weak bullish signal. This resistance line is not too long held. It only has 3 anchor points, and more importantly, it has a reasonable slope, which reduces its technical significance. RSI has been brought well down from overbought. It reached oversold with that big bearish move. It's well back up into neutral territory. It's not yet overbought. There's room for price to continue higher. ADX is declining. There's no clear trend. The DX lines haven't crossed over yet. MACD is bullish but not fully so, and ATR is declining as price is moving sideways and then higher. That's absolutely normal behaviour for this market. At the daily chart level, we're in a zone of stronger resistance and support. Resistance now is at 3,200, and above that at 3,350. I'm going to be watching this gap really carefully. If this is a breakaway gap for a longer term bear market, then it should remain open. But if this is a breakaway gap only for this movement down, then it should be closed. So closure of this gap plus what's happening with the AD line, if this gap is closed with a new high above this low on this candlestick right here, then probability shifts toward a more bullish outlook. That's one reason why I'm providing that pathway for you this week. Volume at the daily chart level is quite strong and rising this week. This is quite bullish volume. I'll be expecting a continuation of upward movement next week up toward that target. ADX is indicating now that there is an upward trend, possibly in a very early stage. This is the most bullish signal ADX can give. ATR is declining as price moves higher, absolutely normal behaviour for this market, and that can continue for quite a long time. On balance volume has no new range. It is making new highs, but I've had a look back at the bear market from October 2007 to March 2009, and in the middle of that bear market, and one of those big bounces that interspersed it, on balance volume made substantial new highs, and it remained making new highs for quite a long time, and yet the bear market continued. So I am not going to give that much if any weight. RSI has reached into overbought, and so conditions are just now beginning to become extreme. MACD full ball bullish. Stochastics has been overbought for a while. but volume suggests we're going to get more upward movement before this upward movement is done. Let's take a look at the AD line, because this week it's made a new all-time high. This is the NYSE All Issues AD line. I also subscribe to Lowry's because their data is very good. They have an operating companies only AD line, which takes out a lot of the companies that aren't actually operational and takes out a lot of the noise and gives us a clearer picture. Their operating companies only AD line has not yet made a new all-time high. If it does, my analysis would have to become more bullish, because the technical evidence for a bull market would be gathering. But right now, this is the reason why I'm publishing a bullish wave count for you. I need to consider that possibility because the technical evidence tells me I need to do that. When the AD line makes new all-time highs, often price will follow. However, back here, we had absolutely no divergence in February 2020 between the AD line and price, and I warned that that meant that the probability of a bear market was very low, because bear markets are almost always preceded by a minimum of 4 to 6 months bearish divergence between price and the AD line, and this bear market came after zero divergence between price and the AD line. That had only happened once before in Lowry's 90-plus year history, and so the probability of this happening was very low, and yet it did happen. This is technically a bear market because it has retraced over 20% of market value. This was unexpected. Well, I had expected some downward movement, but I did not expect it to be this deep and this strong. But here we are. And so I am slightly suspicious of the behaviour of the AD line currently. It did not lend itself well to us for this movement. It may be giving us a false signal, a false bullish signal here. And so I do want to have a little bit more reliance on Lowry's operating companies only AD line for that reason. I want to be quite cautious here. But I'm also going to consider all possibilities. At the daily chart level also, the AD line is making slight new all-time highs. Price is still yet a little ways off. Inverted VIX is moving higher, as is price moving higher. Upward movement from price this week has support from a normal decline in VIX, but VIX does remain relatively elevated. This is inverted. VIX does remain relatively elevated, and there is still extremely long-term bearish divergence between price and inverted VIX. At the daily chart level also, both price and inverted VIX moving higher. And finally, let's take a quick look at the yield between the 10-year Treasury maturity minus the 3-month Treasury maturity. When this chart is below the zero line, we say the yield curve is inverted. When this happens, usually a few months to about a couple of years later, we enter a period of economic recession. It happened back here at the end of 2000 into 2001, and then we had an economic recession, which corresponds with that huge bearish move in the S&P, which we call the dot-com crash. It happened again before the global financial crisis. It happened again back in 2006. The yield curve inverted, and then a couple of years later, we entered an economic recession, and the S&P was in a huge bearish market, as it almost always is during a recession or a depression, which should be, and it should be still considered a leading indicator. I would be very surprised if this indicator fails in this instance. This is one of the most reliable leading technical indicators of an upcoming economic recession. The yield curve has inverted in May 2019, which means we would expect, if this follows its usual fairly reliable, very reliable pattern, for an economic recession to begin in May 2021, around about that time. And if that happens, you would expect the S&P to be in a bear market. That would be normal behaviour for these. And that would possibly fit with my third alternate monthly wave count. That's all from me this week with a rather long video for you. I do hope that was as It's as clear as I can make it, and I hope it was digestible. And I also hope that all of our members are having a fabulous weekend and you're all staying safe.